Good morning, everyone. Welcome to our Phillip Securities Research morning call for equity strategy, a summary of what was held on last Saturday. Some comment on impact from the Trump trade tariff on US. We also have some counter updates on C Limited and our usual S&P 500 for technical analysis. This is our usual disclaimer. The information provided here is only for educational purposes and should not be considered as financial advices. I pass the presentation to Zain for the technical analysis.
Thanks, Fahmi. Good morning, everyone. I'll move to talk about some of the technicals. Next slide, please. Okay, yeah, so this is a chart of the S&P 500. Last week, especially on Thursday and Friday, we saw a very strong sell. It was down 10% in 2 days after the bearish flag breakdown. So I think a key level to watch out at the start of this week will be likely retest of this upward support line from the March 2020 bottom. So this about this level is around 4,900 points over there. Yeah, so we see whether we can there could be some rebound from a retest over here. So current support is at 4,920 to about 5,010. Resistance will be around 5,200 onwards. Yeah. Next slide, please. Yeah, so also with the current market volatility, there's also something to take note will be there was a very large single day rate of change for the VIX on Friday. So that reached about there was a 50% jump for the VIX. So that's quite notable as compared to the recent spikes around these past 5 years where it reached about above 50. Yeah. Next slide. And so I'll be talking about some of the forward short-term S&P 500 returns following this kind of recent short-term following this kind of recent large single-day rate of change for the VIX. So previously, in the past 5 years, we've seen VIX registered single-day rate of change from 50 to about over 70%. On average, the 1 week returns is about 1.6%. In 2 weeks' times, it's about 3.7%. In about 1 month, it increases to about 4.3%. So it's largely positive when we've seen these kind of large spikes in terms of the VIX in a single day. Yeah, so this as of last Friday is about 50.9%. We still need to see tonight whether what is it like. So as of Friday, it's about 50.9%, and we see how is it like for the week ahead. Yeah, and that's all from me for the technicals. I'll hand over time to Paul to start off with the summary of our Singapore second quarter strategy and stock picks event, which was held last Saturday. Thanks.
Yeah, thanks, Zain. So as usual, after our usual quarterly presentation, we will do a quick summary of what we've done. Yeah, in this market environment, of course, it's easy to just recommend bonds and just go buy REITs. But for us, we think the reason why we are promoting small mid caps, we'll explain later, because we think that after so many years of sluggishness, we think there is some opportunity for it to recover. That's why we meant by this, it's alive, it's moving. Yeah, it's like this motionless body that started to move. I mean, like Frankenstein. Yeah. Next slide. Okay. So we just next slide. So that's the Singapore flag surviving the trade war. Yeah, next slide. Okay. Let me just the previous slide. Okay, let me just explain a little bit on this side. So just to recap, this is the so-called tariffs that's being imposed. I mean, if you look at Vietnam, Vietnam is going to be the worst hit. So for Vietnam, the 90% tariffs is basically the deficit over imports. I mean, so it's more a measure of deficits, the percentage of the imports that's deficit rather than the actual tariffs that's being implemented. So of course, then Trump imposed 46% tariff on Vietnam. But you can see on the far right here, in terms of the US exports as a percentage of Vietnam's GDP, it is huge. I mean, it's like almost 30%. So you can imagine, even if this is half, the impact on the Vietnam economy is going to be pretty severe. If you were to ask me which listed company is the most impacted by a soft Vietnam economy, the notable one was going to be Sabeco, which is owned by Thai Bev, which is the beer company. For Singapore, on paper we have the lowest tariff in the world now. So it used to be China +1, so I'm not sure what is going to be, because there's no more. There's like no China, no more, the +1 also disappeared. Maybe it will become Singapore plus something. I mean, yeah. But anyway, it's just to show you that these tariffs are not based on actual amount. It's not reciprocal. It's more like discretionary to reduce the deficit. But on paper, Singapore is basically 15 to 20% more competitive than many countries overnight. Next slide. In terms of the recession risk, even before these tariffs were announced, you can see that the GDP now, which is measured by Atlanta Fed, has already turned negative. Of course, there's a bit of technicalities here. It's more that the way you measure GDP is that when imports come down, it's considered a contraction to the GDP. But I think before the tariffs happened, there was a surge in imports. So if you want to just have a back of an envelope estimate, if you assume the tariffs imposed by the US is like a tax, so it's like the US government tax everybody, and if you take 3 trillion of the imports, annual imports by the US, and you just impose 20%, which is the average based on all the tariffs when they announce the reciprocal tariffs, you're talking about the government taking back like 600 over billion in taxes. So this is a big contraction to the economy of almost 2 percentage points. And of course, this excludes the indirect effects because don't forget, US is also a major exporter, and the exporters are also going to get hit. So US exports also 2 trillion, the second largest exporter in the world after China. As a country, of course, EU combined will be the second. Next slide. So for us, we think interest rates will come down even by the Fed. The other countries have already come off. We still think that the US will come down, because although Powell mentioned that the tariffs will of course will cause some inflation, but we think the Fed will favor growth or favor employment over inflation. He has to wait. If employment really collapses, obviously he's going to cut rates. He's not going to just let it see, and especially when he thinks the tariffs are going to it's going to be temporary. In terms of the impact, I should have mentioned this earlier, but in terms of how we view it impacting as a global recession, again, it's never clear. I mean, like China exports to US only 2% GDP, but one thing that makes us again, hopefully not naive, but we think that the global recession is different from a COVID or global financial crisis, is that this time around the European countries are actually responding with aggressive fiscal spending, like Germany, and so forth. Of course, China will be next. Secondly, interest rates, like this chart is mentioning, has been cut. And the third reason is that this is like a man-made disaster. So I mean, he can virtually overnight kind of turn off, or at least taper down the tariffs, and the market can rally. But again, the thing is his tolerance level, which we'll discuss later. Next slide. So in terms of the impact by the various sectors, the worst hit will be, of course, manufacturing or electronics. So we come from two grounds, because there is nowhere to hide. The supply chain cannot adjust. So because the supply chain cannot adjust, we think everybody has to share the burden. Consumers will take a hit, manufacturers will take a hit, suppliers will take a hit. And when you raise prices so much, of course, demand is going to pull. The second thing is we don't think any customer is going to keep a lot of inventory. We think orders could also be cancelled, because no one's going to because of the uncertainty, no one's going to have a lot of inventory in the shelves, because you're not sure what's going to happen. Of course, in the near term, it will be stocked up because to avoid the tariffs, but longer term, because of that, I think one's going to hold back. And the one that will be the worst hit, of course, is Valuetronics, because they are a real victim of the trade war because their manufacturing was mainly in China. Then because of the tariffs on China in 2018, 19, they shifted to Vietnam. And then now Vietnam's also hit. So there's virtually no place for them to hide. I'll move on to next slide. Okay, so we'll just explain why we still like small caps. Next slide. So basically, there are basically three reasons. Of course, the first one we'll talk about is the liquidity injection. Second, we don't have the slides, but we discussed in strategy. Second reason is because the valuations are cheap. If you look at the privatizations that have been done, the last 7 years, most of the privatization is at 50% premium. It just shows that from a bottoms up, there's a lot of valuations, and a lot of the sectors in the small cap, like commodities, property, like Propnex, they aren't going to be directly impacted by the tariff unless you're talking about a world global hard, really deep recession. Then all these will be affected. But we think for them, for now, most of these small caps are like a shelter from the trade war. But the more important catalyst is the injection of liquidity from the MAS Equity Development Program. So the MAS is committing to 5 billion. If you look at this chart, of course, we don't think all 5 billion are going to go into small mid caps. So if you look at the universe of small mid caps, 1 billion and below, the market cap is roughly about 60 billion. If you take free float, I mean the one that is investable, you're talking about 25 billion. So even if you pull down the number to 1 billion, you're talking about 4%. But the real investable, because that 4% is over 400 companies, but really investable with volume is probably less than, it's probably only 100. So if you just take if you just take 1 billion over 100 companies, which I think most fund managers can only follow 100 companies, you're talking at least a 10 million injection to a lot of small mid cap stocks. So that's why we think this is going to be the big catalyst for small mid caps. Of course, timing wise, we think it will only going to happen in the third quarter. Yeah, because right now we think MES is sifting through all the fund managers who they're going to award. Then once that award, it will take time. Then probably only third quarter you see the money coming in. But of course, we can't wait until third quarter. That's why we are preparing it now. Next slide. Okay, I hand over to Zain.
Yep. Thanks, Paul. I'll talk about technical outlook for the Singapore market in the second quarter. Next slide, please. So for the blue chip ES3 ETF, in terms of the chart, it has been steadily trending higher inside the uptrend channel. So it's demonstrated a bit of resilience, remaining at the upper end of this mid uptrend channel in blue since November last year. And it has also been steadily trending higher in this short-term uptrend channel in black. So with that, we could see a bit of a sideways consolidation in the second quarter. Could inch up a little slightly higher towards 395, $3.95, which is about a 3% upside from Friday's last close. Next slide. Next one, we'll be looking at the small cap index, which is looks like it's gearing up for a key breakout. So actually, it made a double bottom at 217 in August of last year, and subsequently it broke out above the 233 resistance level, which subsequently turned into a support following a throwback in November last year as well. And it has maintained well above that level. Currently now it's the key resistance to actually look out for is at 247, which has tested 3 times since about December of 2023. So with that, we have about 257 as our second quarter target, which is about 8% upside as of Friday's last close. Next slide. And in terms of large cap pick, stock pick, we have, in terms of technicals, we have a DFI retail. So it has exhibited a bullish reversal, which is gaining steam since March of this year. So price being a double bottom at $2.01 in the start of March this year. Subsequently, it recovered above the $2.13 previous breakdown level in mid-March. It has held steady and broke out above a bull flag, highlighted in blue as well. So with that, we could see a potential target at $2.53, which will be a retest of the swing high form in December of last year. So that's about around close to 12% upside as of Friday's last close. Next slide. And next one for mid cap pick, we have Geo Energy. So it broke out of a consolidation finally. in March this year. So previously it was held in ascending triangle consolidation since August of last year, but it has been making higher lows along the way and broke out above the 30 cents resistance in mid March this year, following which it consolidated in a bullish flag between 30 cents to about 33.5 cents. So if there's a breakout above this 33.5 cents resistance level this quarter, we could see the price hit towards 37 cents, which was a previous swing high resistance formed in mid-March last year, as well as it meets the projected target level of the ascending triangle breakout as well, which is about, when we take the height of 7 cents projected on the breakout level at 30 cents. So all in all, the 37 cents level would represent about 19% upside as of Friday's last close. Thanks. So that's all from me. I hand over the time to Glenn to talk about the Singapore banking team. Thanks.
Hey, thanks, Zane. Yep. So, yeah, can you hear me? Yeah, okay. Yep. So for the Singapore banks, yeah, we just put this fun picture here, basically showing the three banks throwing money at the people, which is the investors and shareholders. So they're doing this by doing a lot of capital, excess capital returns, and in terms of dividends, share buybacks. Yeah. So we'll go into more detail later. Yeah, next. Yeah, okay. So just before I start, let me just briefly speak on how the Trump's tariffs, and also basic. I think there's one question pointed to Darren, but it's more for me about what is the risk to the banks regarding a US recession. Yeah, so just the tariffs don't really impact the Singapore banks directly. If you look at their loan book, only 15%, around 15% of their loan book is to the ASEAN countries. So majority of it is still in Singapore. So in that sense, the Singapore banks are quite protected in terms of loans growth, because a lot of it is really going to the Singapore side, right? Of course, you'll see a slight hit in terms of loans growth. We might see a slight dip. Maybe they won't be as optimistic as they were previously. But overall, I think the main thing we need to look out for would be the higher allowances. So we might see, credit costs inch up. But then again, with Singapore banks, it's quite unique because they do have a lot of management overlay. And what does this management overlay mean? Basically, it means that they will be able to offset some of their general provisions, and do some write-backs. And if the specific provisions come in higher than expected, and this will allow them to still keep their credit costs in line with what they have been guiding. And we have seen it in the past couple of years that's what they've been doing, and credit costs have always been in line with their guidance. So we believe that all these factors, they are the impact on the Singapore banks are quite low from the Trump tariffs. So hopefully that has answered that very, I think, the big question on everyone's mind. So let me just move on straight to the slides. So the first slide, is just showing the interest rates, as well as the net interest margins and net interest income. So what's very interesting is that we have seen the net interest income actually inch up despite rates coming down and net interest margin also declining slightly. And why the banks are able to do this and how will they be able to continue to do this is that the banks have a lot of excess deposits, and they have even more now because a lot of their fixed deposits are sort of rolling over. So they cannot, a lot of the customers don't really put it back into fixed Ds because rates are so low. So they put it back into their current account and savings accounts. And this very low cost of funds for the banks. And then the banks then take these funds that they have and then they put it back into longer tenure interest earning assets like bonds or treasuries, and that's where they earn higher net interest income. But why we are seeing the net interest margins dip is because loan yields still give a better spread, right? So that's why we are seeing the net interest margins decline, but net interest income is still holding healthy. So moving forward, we believe that they will be able to do this for at least 1 or 2 more years, until, of course, whatever they have put in previously starts to roll over into lower rates. Then we might see this benefit that they have roll off maybe in the next 2 years or so. Yeah, okay, next slide, please. Yeah, okay, so I think this is the biggest point for the Singapore banks, which is the dividends. So total dividends, right, we expect it to increase by 27% going into FY25. And this is really coming from all of the capital returns that they are doing. because they have so much excess capital that they have to give back some. Otherwise, it's just sitting there, and it's actually it's not a positive thing for the banks. So going into FY25, we believe that it will increase by 27%, and also that the dividend payout ratio will also increase. So DBS has mentioned that they do not really keep a very strict dividend payout ratio policy. So they give us a sort of a total sum of how much they're going to be returning. Whereas the other two banks are sticking to a 50 plus 10. So in a sense, a base dividend is a 50% dividend payout ratio, and then they'll give a 10% special dividend in terms, this is sort of their capital return initiative. So that's why we expect that, dividend payout ratio can go up to around 60 to 65% for the Singapore banks. And, if you look at the current share prices now, the banks are, our FY25 forecasted dividend yield is around 7.3%, and on average for the three banks. Now, moving on to the next slide. Yep. So I think we also have quite a few questions that the bank's price to book ratio has skyrocketed, and is it a lot of people use this ratio to see if the banks are worth buying or is it too expensive. But I think another important ratio that it's good to look at with the price to book ratio would be the return on earnings, or ROE. So you can see that the ROE has increased in tandem with the price to book ratio, is on par. Right, so a higher ROE is really coming from the stable earnings of the banks, as well as the reduction in excess capital. So you're reducing the denominator while the numerator actually stays quite stable. Hence, they get this high ROE. And why is a high ROE important is because it will improve the valuations for the banks. So we believe that the high ROE is actually quite attractive. Now, moving on to the next slide. Yep, so we're moving on to our stock picks. Firstly, we have OCBC, which we like because they still have the highest excess capital ratio and the highest CET1. So their CET1 at FY24 is at 15.3%. So it's still the highest amongst the three local banks, and they have excess capital of around 3.4 billion. And the capital distribution, we believe, will lower their CET1 to around 14.3%. But if they continue having stable earnings, this will just continue to accrue more capital. So we believe that they can still continue to pay this special dividend of an additional 10% dividend payout ratio for at least 2 more years. So up to all the way until 2027. Yep. So 2026 and 2027, we believe that they can continue paying. Now, moving on to the next one, the next topic, we have UOB. Why we like UOB is because they do have we believe the highest earnings growth as compared to their two peers. Right, we do expect that the FY25 PATMI will grow by 12% year on year, and that the city acquisitions that they have done will accelerate their growth by around 2 to 3 years, into this non-interest income, and shifting away from their traditional net interest income sort of commercial bank that they are known for. Of course, the tariffs will have a slight impact on how fast they can grow in terms of loans, and non-interest income in the ASEAN countries that they're in. But we believe that it will still be a good way for them to grow out of being a traditional commercial bank. And that's why we expect the PATMI to still grow by around 12% year on year in FY25. And that's why we like UOB. So I think that's all I have for the banks. I'll now hand it over to Darren for the REITs. Thanks.
Yeah, thanks, Glenn. Yeah, so for the REITs, we think it's a good time to enter because during a recession, REITs are usually more resilient. So I have one slide over there, but I mean in the next slides. But for our picture here, basically I try to show that in the background there's a storm, which means any geopolitical tensions, any war, any headwinds like trade war. Despite all that happening, the buildings are still standing up straight, and the tenant still has to pay rent. So happy or not, the tenant just have to pay. So you see the guy on the right, which is the tenant, just throwing his cash at the landlord, and all the money is all over the place. Yeah, so that's the story here. And just nice, there's a question which in the chat which asks how SG REITs performed during the recession. So I have that in the next slide. Yeah, so next slide, please. Yeah, so looking at this chart, so from 2006, so that is a zero rise. So from 2006 until 2025, we see the S&P 500 it rallied around 600%. The REITs were up about 250%. Yeah, so we see the red box here. It shows that when the S&P 500 is down, the REITs usually doesn't fall as much. I mean, it still falls, but it's less volatile, so it falls lesser than the S&P 500. And there is a little bit on negative correlation as well. We saw over the past month or so, the S&P 500 started to fall, but the REIT index actually it rose. Yeah, that's mainly from expectations of more rate cuts. As Paul mentioned at the start, possibly the Fed might have to cut more rates. And if I'm not wrong, I think the latest futures already showing 4 rate cuts as of now. So with the Fed likely to cut more rates, then REITs will start to benefit from lower interest rates. So how REITs benefit, basically they have interest savings. They pay less interest expenses. The cap rate will also likely compress, so property valuations will likely increase, and transactions also might pick up pace because with cheaper loans, yeah, investors are likely to borrow and start buying properties as well. Yeah, so this is the chart. It just shows that the REIT index is less volatile than S&P 500. Yeah, next slide, please. Yeah, so this chart shows the forward dividend yield and the absolute number of DPU growth. So the shaded region in the background, the beige and the light blue, it shows the year-on-year absolute DPU growth number. So that is the right-hand side chart. So the negative part is the beige color. So we saw 2023, 2025, we saw that the REITs actually had a negative growth, but that's mainly because of higher interest expenses. The Fed started raising rates, so as a result, the REITs they couldn't. The NPI growth lacked the growth in interest expense. So as a result, most of the REITs, or rather the majority, or rather all of the REITs, they saw DPU declines. Yes, but going forward with the Fed really having cut 100 basis points last year and more rate cuts to come this year as well. So that will start to flow through, and REITs will start benefiting from lower interest rates, lower interest expenses, and as well as because half of the REITs have already repriced all their existing loans to market. So this year we're expecting about half of the REITs to start experiencing lower interest expenses, and the rest of the REITs to follow suit starting next year. So as a result, we expect DPU to grow about 1% this year and about 3 to 4% next year. Yeah, and the line chart here, it just shows the forward dividend yield of the REITs. Because of the share price performance, it's quite weak, and despite the lower DPU, absolute number of DPU, the forward dividend yield is still higher, but that's mainly because of the weak share price. It's now trading above the historical average. So based on those metrics, we are still getting a good solid 6.2% yield. So we think that is an attractive. Yep. Next slide, please. Yeah, so now this is the price to NAV chart of the REITs, the S-REITs index. So now it's trading at even below COVID-19 lows. Now it's about 0.83 times. So we don't think this, we think this discount is unwarranted, mainly because property valuations are likely to start increasing going forward, especially with cap rate compression. So we saw the Australia, they cut rates in February this year. So that is all the latest in around the world already. So with that, likely cap rates possibly remain stable, and even maybe at the end of the year might see some compression. But we still saw some cap rate expansion for Australia and some other countries in FY 2024's VM valuation results. Yeah, so going forward, it's unlikely that cap rates will continue to expand, and as a result, property valuations will likely increase, and we therefore think the discount to the NAV is unwarranted for most of the REITs. Yeah, but like for Singapore, we saw through COVID, cap rates remained flat. Yeah. Next slide, please. Yeah, so this is the 10-year dividend yield spread. It just shows how much investors are being compensated for investing in the risky asset REITs over like your fixed deposit rate, or in this case, we use the 10-year Singapore government securities as a risk-free rate. So now we see the 10-year dividend yield spread continues to increase. especially from the fact that the 10-year yield continues to decline, and the forward dividend yield we think will likely increase from the absolute number of DPU, the absolute DPU number increasing as well. So basically, this is it will expand both ways. So as a result, the 10-year dividend yield spread will increase, and we think that is more attractive. It will start looking more attractive as it moves towards its historical average of about 3.6 times. Yep. Next slide, please. So moving on to our topics. So first of all, we have Stoneweg European REIT. So we like Stoneweg for its high yield. It's paying 8.8%, and they've already completed their refinancing, so they do not have any refinancing requirements until the fourth quarter of 2026. After they recently refinanced the big bond maturity, which was in November. So that existing bond, or rather the bond that they just recalled, that one was at 2.125 coupon compared to the 4.25 that they just recently issued. So as a result, they will experience higher interest expense this year compared to last year. But despite that, we've already factored that into our model and our numbers, and they're still likely paying 8.8% dividend forward dividend yield. So we think that is attractive. And you see this chart here, this is the portfolio occupancy. So from IPO until now, the portfolio occupancy has increased, and it remained resilient throughout COVID and the war as well. So that is they've proven their resiliency. Yeah, so that is why we like Stoneweg. Next slide, please. And next we have CapitaLand Ascott Trust. So first of all, the portfolio RevPAR has shown some good recovery since COVID. So going forward, we also expect mid-single digit RevPAR growth. So that is the growth income that contributes about 38% of their most recent results, and they also have a stable income sources from the master leases and management contracts with a minimum guarantee income. So those contribute about 60% of the full year results, 2024 results. So that will set the stable base in a situation where in case there's a recession and the US consumption slows, and basically consumption worldwide slows and less people start to travel. So at least they have that 60% to set the resilient base for them. And the class, they also have a strong asset recycling track record, where we saw them divesting a lot of assets at a low yield, or assets that hit the maturity, or rather the mature stage in their life cycle, and reinvesting these proceeds into higher yielding assets. Yeah, they did some last year, so that is a strong track record, and we think that's likely to continue. And there's also still 300 million of undistributed previous divestment gains that are likely to top up this year, because some of their assets that will undergo AEI. So they've guided that if the DPU from operations doesn't hit last year's amount because of these AEIs, they will use this undistributed previous divestment gains to top that up. So minimally, the DPU will be flat year on year for class, and assuming that the forward yield for class is 7%. So we think that's attractive, being a CapitaLand name, because usually CapitaLand and all the big players with CapitaLand Maple sponsors are trading about 5-6%. So 7%, we think that is attractive. Yeah. So that's all for me. I'll hand over time now to Iqbal. Thanks.
Thanks, Darren. I'll be talking about Singapore construction, and our team is building the boom, because we think that this year and the next few years will be the boom for construction. Yeah, next slide, please. Yeah, so in this chart itself, the dark blue line represents the contracts awarded, whereas the red line represents the progress payments. So that means when the companies actually take in the revenue and profits from the contracts itself. So that is represented by the red line. So as you can see, the dark blue line has reached record levels high at 47 billion. And BCA actually forecast that 2025 it will reach 50 billion, which is even higher. And that's why we think that for the construction progress payments in the red line, we think that the companies will actually continue to trend higher because of this. And this is being driven by the Terminal 5 beginning construction in the first half of this year, as well as the ongoing HDB BTO projects, as well as the expansion of LTA MRT networks, and also the expansion of the integrated resorts for the private sector. Yeah. Next slide, please. Yep, for talking about WeHer, yep. Recently they have a huge announcement about the PBSA disposal. But I'll now talk about the charts first. Yep, for second half 2024, as you can see the revenue and PATMI, which is represented by the red color line for the PATMI, it dipped for the most recent announcement because the construction actually underperformed. The construction segment is represented by the gray color bar. However, as you can see, for the dark blue color bar, the worker dormitory segment, it actually held very steady. And we believe that for the second half of 2025 itself, it will help to spur revenue and PATMI growth. As for the recent announcement about the PBSA disposal, recently they completed the disposal and they took in $300 million in net proceeds. And after they took in these net proceeds, they will give out 0.07 special dividends per share, which represents 14% yield, which is quite a lot. And even after distributing the special dividends, they will still have net cash of $122 million. So this is about like 30+% of their market cap already. WeHer currently trades at about 33% discount. Actually, now it's even more because of the recent dip to their NAV per share. As for their remaining disposable assets after selling these PBSA assets, they have a remaining 13% stake in the PBSA Fund 1, as well as also a 30% stake in the PBSA Fund 2. So these two add up together will give them a fair value of about $200+ million. And yeah, so this is the thing we can watch out for. Even though the timeline is uncertain, we still don't know when they will sell. Yeah, next slide, please. As for Centurion, as you can see for the past few years, the growth from all segments have been very steady. However, in December itself this year, worker dormitory supply has matched demand. However, we do think that there will still be continued growth because of the prevailing rental rate revisions. Because for a typical worker dormitory lease itself, it lasts for 1 year. So for the leases for example, which starts from maybe June last year, it will continue to until June for this year itself. So that will continue to drive growth in revenue and PATMI this year. And they also have a new 1.6K bed dormitory, Westside OB, which starts to take in starts to become operational in March this year. Yep. And we also think that the continued shortage of student accommodations in Australia and UK will continue to spur the growth in the two segments. Yep. Next slide, please. For BRC Asia itself, they mainly provide steel for construction itself. So for example, the steel rebar that is used in concrete works and so on and so forth. For their most recent quarter announcement, the revenue actually dipped a bit because of some project slowdown, as well as the drop in steel prices. However, they recorded their highest ever order book, and we think that this order book it will support their revenue growth. We think that the order book can be completed within 3 years because of the construction cycle, and because BRC Asia holds a huge market share in steel itself, of 60 to 70%, we think that the boom in construction will drive their growth. And they also pay out quite a huge dividend yield of around 7% now. Yeah, so we think that it's also attractive because of this. Yeah, next slide, please. For Pan United, they deal with ready-mix concrete within construction itself. So as you can see, for the red color line, it represents their revenue. As for the blue color line, it represents the volume of the ready-mix concrete. And as you can see, they are quite closely correlated. For BCA, BCA actually forecasted volume of ready-mix concrete to grow by about 6% year-on-year for 2025 itself. And we also forecast revenue growth to be around 7% year-on-year growth for Pan United. And because the price of ready-mix concrete holds quite steady, we think that this growth will actually materialize. And because Pan United holds a huge 40% market share in ready-mix concrete in Singapore itself, we do think that the boom in construction will continue to drive growth in their stock itself. Yeah, so that's all for my end. I'll hand over the time now to Miao. Thanks.
Yeah, I'll go through the small cap picks. Next slide, please. Yeah, so here's a list of the stock selection for small caps. We believe they are pretty good investment option if you are looking for a trade war shelter. Next slide, please. Yeah, so this is CNMC Gold Mine, we just initiated last week. Here's the map of their flagship Suku project, and a comparison of their production versus the resources. So even with 60% increase in production, the current resource still remains sufficient for extraction over the next 26 years. And they also have a permit valid till 2034, and they are very confident in extending beyond that, given the successful track record. And our target price is based on 10-year production scale. Next slide, please. And instead of buying a good ETF directly, we believe this is a leveraged play. As CNMC is ramping up its production from FY25 onwards. Yeah, so we believe production will increase by 20% year-on-year due to the introduction of the new CLI facility, which will be ready by second half 25, and boost capacity by 60% thereafter. And also our gold price has been on multi-year high, increased by 20% since the beginning of the year, surpassing the 3,000 level. And the market remained bullish on the outlook due to the highlighted geopolitical pressure, tension, and also aggressive central banks purchases. And the CNMC will be the key beneficiary since they sell gold at the spot rate. And we believe selling price would at least increase by 18% year-on-year to 2.9 thousand. And therefore, PATME is going to be driven by increasing operating leverage since majority of the costs are fixed costs. So we believe PATME would increase by around like 47% year-on-year. And even at the selling price of 2.9 thousand, we're still looking at a huge chunk of free cash flow. Yeah, so this year they will generate around 24% in terms of free cash flow yield. And at the dividend payout ratio of around 40%, which they tend to increase in a year of strong financial performance, we are looking at dividend yield of 5.6%. And next slide, please. Yeah, so Zixing, the Chinese sweet potato operator. And we like Zixing because Chinese government has been advocating food securities in China by allocating lands and resources. Yeah, so we believe PATME would at least triple to 34.8 million in this financial year, driven firstly by the increasing sales of fresh sweet potato products, which we expect the sales to double with the introduction of the cold storage facility, which extends shelf life from 1 week to 1 month. Yeah, thus enabling like additional distribution channel, yeah, such as a supermarket. And they have also been diversifying its revenue sources, such as animal feed, since Chinese government is advocating to lower the soybean content in animal feed from 14.5% to 13%, with sweet potato being the key substitute. And the market is also huge in China, with annual consumption of around 480 million tons per year. So the first batch of revenue is expected to kick in from fourth quarter this year and generating to around 500,000 in FY26. The next slide, please. So a small cap selection for the REIT sector. We like Elite mainly because of its very attractive dividend yield. And 99% of the income is coming from the AA rated government tenant. And they currently have more than 140 properties with occupancy rate at around 93%. And we believe occupancy rate would maintain at least at this range till 2028. Therefore, unitholder is able to enjoy 9.7% dividend yield for the next 4 years. They are also very actively engaging with its largest tenant, DWP, for early renewal ahead of 2028. Yeah, so we are looking at around like 25% to be renewed by the end of this year. And they are also working on the divestment strategy to monetize some of the mature asset. And with Bank of England cut its benchmark rate by 25 basis points, we believe this would help the transaction market and also strengthen valuation. And by the end of the year, assuming like all the proceeds will be used to pay down debt, gearing would drop to below 40% range. And that's all for me. I'll hand over to Paul for the rest of the small caps.
Yeah,
Thank you.
thanks. So we just run through it very quickly. So we initiated coverage on Geoenergy last week. It's a thermal coal producer. They have 4 concessions in Indonesia. So 2023 was a game changer for them because their reserves were running low. So they decided to acquire one mine called the TRA Core Mine through a listed Indonesian entity for I think about 200 plus million. Then they are going to invest 150 million on the road, funded mainly by Chinese contractors. So they will only pay 2 years later. If you look at the map on the left, you can see this blue line. So that's what they're going to build, this 92-kilometer road. Next slide. So in terms of why we say there's a multi-bagger optionality or opportunity here is because firstly, this year we think volumes will grow by almost 43%. And sorry, my camera. Then the second trigger will be with this new road, their production will triple from 8 to 25 million by 2029. The road will only be completed second half in the middle of 2026, but in the meantime, you're going to get this big jump in growth for this year. And the third bigger catalyst is because this road is 50 million metric tons. They will have another 25 million metric tons of excess capacity, which they can rent out to other coal miners in that region. So this will give them like additional high margin toll revenue because there's really no cost of it. The road is already there. Next slide. So move on to just Pacific Radiance very quickly. They are oil and gas vessel operator and shipbuilder. After a massive 600 million debt restructuring, we think there's good earnings visibility because they are operating with 3 new vessels that have already been contracted out in the later part of last year, and the revenues profit will all come in this year, and they got 2 vessels under construction that can be either sold or rented out. Next slide. We'll move on to PropNex. I think we're familiar. So they are a very dominant 64% market share in all transactions and with 13,000 agents. So with the home sales jumping almost 6-fold in the first 2 months 2025, they will be the big winner. I think we discussed before. You can see this line chart here, which is the property sales. And then we expect 40% earnings growth, and they will be backed by the special dividend. The 25th anniversary will be in the July of this year. Next slide. So I'll just run through our model portfolio. Next slide. Yeah, so the model portfolio, we took out ST Engineering because the share price spiked 50%, and we took out China Aviation because the dividends disappointed. We added in more small caps, Geo and PropNex because of the reasons that we mentioned earlier. Because of the liquidity injection, and the sectors will be less immune to a trade war. Next slide. These are just for illustration. Next slide. I think you can move on to Q&A. Okay, for the conclusion, we think I mean everyone's going to be infected by this trade war, but we think Singapore actually comes out relatively stronger. Again, the lowest tariffs on paper now in the world. We are still overweight small caps because of the liquidity injection, cheap valuation, and momentum in their sector, in the respective sectors. In the risk of a US recession, we favor defensive REITs, defense, although we took out our model, but these are the sectors, telco conglomerates, that will be less affected by economic slowdown. I mean, when the economy slows, like what Darren mentioned, you're still going to pay your rent. You're still going to pay your mobile phone, and conglomerates are namely power, electricity. I mean, you're still going to keep it on. Of course, you might use less, but they are still generally less impacted by economic slowdown. Next slide. Okay, I hand over.
Hi, I'll just be going through the update report for C very fast. So we issue a report with the title "Further Goes Ahead." Several things we like about C. The first is there's more room for Shopee monetization. So Shopee has been doing really well. They're defending their market share. The GMV growth was 24%, which outpaced the industry's mid-teens CAGR. So the key growth driver is because they're trying to increase their take rate. Their take rate currently is around 8 to 10%, which is still considered pretty low if you compare it with international players like Amazon. So there's definitely headroom for them to further increase. They have said they're going to prioritize advertising take rate, and this we think it's very mutually beneficial growth driver for both the platform and the sellers, because the higher spending will definitely enhance the seller visibility, and this results in increased sales, and subsequently they will reinvest into ads. So it's a win-win. So we view advertising as a very good growth opportunity for them. It is still in very early stage. It only contributes to single-digit percentage of the total revenue. The second good thing we like is C-Money is expanding its off Shopee loan pool. So off Shopee loan pool now accounts for nearly half of the loan book, and primarily comprised of off-platform buyer cash loans offered to the selected buyers who were good using the on Shopee loan credit record. So C-Money has been trying to expand the off-platform lending, enabling its Indonesian consumers to use their Shopee Pay credit amount to purchase digital gadgets in offline stores and apply for like one-time credit increase, providing they have a good record on Shopee Pay previously. So these features, they're expected to drive loan pool growth because Southeast Asia is largely unbanked. The population of unbanking was like 70%. So essentially, people are using it as a virtual credit card alternative. And because these users are already pre-screened based on their on Shopee loan credit, the non-performing loan ratio is able to cap really low at 1.2%. We estimate C-Money to grow around 25% year-on-year in FY25. The last we like is gaming has been doing really well. Because they have been showing really strong double-digit growth in bookings, QAU and QPU. But the positive trend previously we say it has not yet reflecting the revenue. The reason of that being is because there's a delay in revenue recognition, especially when there's an increased popularity of the game. Because the longer they expect the user to actually play the game means the more revenue they're actually going to defer it. Let's say you buy a skin, but they expect you to play the game for 10 years, so they can only recognize 1/10 of the revenue per year. So that is why the more popular the game is, the more portion of the revenue will actually be deferred to the later part. So in the previous quarter, they recorded the first revenue growth in the 11th quarter. So this we think it signals that the positive trend is beginning to materialize, and we expect it to continue in FY25. We expect the revenue growth of around 9% year-on-year in FY25. And actually, when we issued the report, we upgraded to accumulate, but that is before the massive sellout. So share price had actually dropped a bit afterwards due to the terror of the new tariff. But Shopee is actually in a very cozy position when it comes to tariff, because first of all, they do not operate in the US at all. And even in their existing market, Shopee acts more like a third-party marketplace where sellers source and price their own products. So they don't really bear the full burden of the tariff cost. So previously we say we like everything about C, but it's just a little bit too expensive. Now we think it's actually a pretty good entry point now that the prices came down. So that's all for C. But speaking of tariff, next slide, please. Yeah, we actually made a slide to show the impact of the different sectors from the trade war. So I'll be talking about tech hardware. So tech hardware, I think the one hit the most is Apple, because Apple relies very heavily on Chinese manufacturing. 90% of their iPhones are produced there. And the new tariff has led to a 54% surge in the cost of their imported component. So that means previously in the iPhone 16 Pro, the cost of production is $550. Now it's almost $820. So that definitely going to push Apple to raise their consumer prices. And this is going to hurt them because imagine your iPhone 16 previously it was $800. Now they have to add the $300 extra production cost on it. And this is not going to do them any good, especially when they're already struggling with their Chinese competitors. And these Chinese competitors were not going to be facing the same issue as they do. So yeah, we think it's going to hit the tech hardware sector pretty hard. The e-commerce, like I just mentioned just now, we think it depends on what kind of e-commerce company you are. So the impact is going to be high to medium. So for companies like C, we just mentioned because it's not operating in US, so it's probably not going to get hit at all. But companies like Shopify, it would be a less direct hit because it's the same structure. They're more like a marketplace. So sellers, they will source and price on their own. So Shopify didn't really bear the full burden. But ultimately, when the price increases, there are going to be less sellers using the platform. So they're still going to get hit. but we think the medium impact. But for players like Temu and Shein, it's almost 100% hit on the face because all their stuff is heavily reliant on the manufacturer from China. But for players like Amazon, we think it's a mix because Amazon, they have third-party marketplace, so it does provide it with a level of flexibility. But ultimately, it would definitely the tariff would definitely increase the cost of imported goods, especially those from China. We think the hardest hit product sector are likely to be budget electronics, meaning the cheap electronics like headphones, and household goods and apparels. So these segments are the ones where Amazon rely heavily on Chinese manufacturing, and they are very highly price sensitive. Amazon, we think, if the tariff remains in place for an extended period, they're probably unlikely to absorb the cost. So eventually it will be passed to the consumers, and retail margin is already really pressured. So ultimately, the sellers and consumers are the one likely to bear the burden. Moving on to cloud, we think the demand for cloud services is largely insulated from tariff, as it's driven more by digital transformation, not physical trade. So while tariff may raise infrastructure costs, we think cloud revenue growth is unlikely to slow significantly due to the demand resilience. Now I pass my time to Glenn to talk on auto and banks.
Hey, thanks, Elena. Yeah, so just start off with the auto side first. We only do cover Tesla, but just basically on the whole auto industry, it will impact them quite big. Even those US-made vehicles or American-made cars, which Trump said that you don't buy China, you buy US cars. It will impact them because a lot of the parts that come to the cars, right? Maybe not, I would say not 100% of the cars are made in America. A lot of the parts are from America, Vietnam, Thailand, and from China, and they come into US and then they just assemble it and then they say this is made in America. So that will cause the prices to increase for sure. Estimates are around 2,000 to 5,000 per car. And when you're looking at a car in the US, which is around maybe 30, 40, 50,000, that's easily a 10% increase, and we're not sure where is this cost going to go to. Most likely it will go to consumers, and that will cause the demand to go down, and you might see more more Americans actually hold on to their old cars, or even just go to the resale market to buy a second-hand car. And importantly, because we do cover Tesla, it's very unique in a way that they had their production in US, and then they were saying that okay, they are truly American made car. That's true. But in China, what might impact them may not be directly the tariffs, because they do have a plant in China, but it might be more of retaliation from the Chinese public. Now that they are they might be more sided towards Chinese manufacturers, and it's really showing. We have seen the first quarter deliveries decline a lot, drastically, and that might just exacerbate into the next quarter and the next few months, where a lot of the Chinese consumers just go and buy a BYD instead of buying a Tesla, right? Maybe in retaliation to the Trump's tariffs. I think for banks, there is a question asking about the banks, what's my outlook and what's the view on the banks now with the tariffs coming in. There is no direct impact to the banks in per se. If you look at the tariffs, right, there's no direct impact, but the indirect impact is there are many indirect impacts to the banks. Firstly, loan demand will decline. We are expecting the loans will dip slightly. Loan growth recovery will not be as strong as it was previously, mainly due to the higher prices that both businesses and consumers will feel with the tariffs kicking in. Secondly, and I think more importantly, it would be the investment banking fees. That was really the growth driver for the banks for the last few quarters. And last but not least, we also anticipate higher allowances, as the higher cost comes up, demand slows, and there might be higher allowances or NPLs for the banks. So they do need to manage their credit costs quite well for the banks. So we do believe that the impact to the banks will be a medium impact, not so much a high impact. Yeah, so that's all for the banks and the auto industry. I'll now hand it over to Iqbal. Thanks.
Thanks, Glenn. I'll talk about the impact on semiconductor in if there's a trade war. Yeah, so the impact will be high in our opinion. Even though current tariff excludes semiconductors, most companies actually outsource their production to Asia. For example, like TSMC is being outsourced by NVIDIA for their manufacturing itself. Yeah, so if there's a tariff, then there'll be a big impact to companies like AMD and NVIDIA. Yeah, so from this chart itself, we broke down the companies into the different categories. So for processor itself, they are mainly fabless chip companies. So they design the chips and they outsource the production. Most of them outsource their production to TSMC. And as you can see, because most of it is being outsourced to TSMC, if there's a tariff, then there will be a huge impact on them. For example, NVIDIA, which has 47% of their revenue to the US. And as for memory itself, for companies like Micron, Samsung, most of their manufacturing is also to Asia. However, they have a big percentage of their revenue to US. So if there's a tariff occurring, there will be a high impact as they export their chips to the US itself. For equipment itself, ASML, Applied Material, and Lam, their plants are mostly scattered in the US and across Asia. Yeah, and they don't really have a big percentage revenue to the US as compared to the rest. This is because equipment providers, they supply their equipment to foundries itself, for example, TSMC. Yeah, so TSMC is a huge foundry that they supply their equipment to. So most of their revenue will come from there. Yeah, so we do think that as compared to the rest of the semiconductor companies, the impact of tariff will be medium. As for foundry itself, TSMC, most of their fabs is in Asia. However, a big chunk of their revenue is to the US. So if there's a tariff, there will be a high impact on them. I think there's some questions about the impact of tariff on Singapore semiconductor companies like Franken, UMS, and AEM. Yeah, so their main customers are ASML, Applied Materials, and Lam Research. So even though as compared to the rest of the semiconductor, it's a medium impact. However, it's still quite substantial. That they will actually be impacted by the tariff itself. So I think that's why the negative sentiments cause their stock prices to drop. I will get more in depth to the questions later. Yeah, thanks. I'll hand over the time now to sorry, I think now is the Q&A time. I'll hand over to my colleagues. Thanks.
Yeah, let me take on the questions first. I think quite a few on the banks, worries about the dividends. Yeah, very valid questions. Hold on. Yeah, Fahmi, can go back to the QR code slide. Yeah, just leave it there. Yeah, okay. Hold on, sorry. Let me just find the question again. Yeah, okay. Just go by order. So this question is asking which Singapore bank is less impacted by tariffs. You could for that question, it's a good question. We just look at I would say the geography of the banks. Where is their loan book? Where is their assets, liabilities? So I would say for now, you can look at DBS and OCBC because they are more Singapore centric, right? Majority of their loan book is in Singapore. Not saying that UOB isn't, right? But compared to UOB, they have the least exposure to ASEAN. DBS has the least exposure to ASEAN actually. Yeah. So if you're saying least impact, indirect impact, I would say DBS has the least impact. Okay. Any thoughts on the tariff impact on Singapore banks? Yeah, I did mention earlier, but just to do a quick recap, that the Singapore banks are, like I said, they only have around 15% exposure to ASEAN, so they're not as impacted. We could see a slight decline in their loans growth. They are now guiding for mid to high single-digit loans growth for 2025. So we could see a slight dip, depending on their customers. If they don't really show their customers how much exposure they have to the US, but I would say we could expect maybe a lower guidance now. We could look at maybe mid-single digit or slightly below that for loans growth. And also importantly is their allowances. Like I mentioned earlier, we could see a pickup in allowances, but for the Singapore banks, they have been hoarding this what you call a management overlay, right? So they don't specifically say how much they have. Only DBS says it. They say they have around 2 billion worth of management overlay, and this is important because they can release this and have general provisions write backs if the specific provisions come in too high. So both general and specific provisions make up the bank's credit costs. And by lowering one, and if the other one goes up, what happens is that they can maintain their credit costs in line with their guidance. So that makes at least the analyst's job a lot easier, where we can see, okay, this is what their credit costs are going to be moving forward. Which bank counters to accumulate? I said earlier our picks would be UOB because we believe that their growth will be the fastest, and OCBC because they have the highest excess capital. Okay. Any fundamental re-rate? Sorry, where did that question go? Hold on, sorry. Yeah. Any fundamental re-rating for the banks? Yeah, if there's any, I will be sure to let you know, and also do some slides on that. But fundamentally, the banks are still quite similar. All right, fundamentals haven't really changed. Like I said, the only difference that we might need to adjust would be the loans growth, where in terms, we were expecting mid to high single digit, but now we might be looking at mid single digit or slightly lower than that. Yeah, so to the pertinent question is, will the banks still, I think there are a few questions on this. Will the banks still return capital if recession hits? Yes, not just recession, but with the share price going down, there's a sell-off, and also with the tariffs coming in, will the banks still return capital? And I think that's the most important question, and I believe that yes, they will. So the Singapore banks, they've already promised that amount, right? They have said that they will give back this much. And they do have more than enough excess capitals. It's around 2 to 4 billion dollars worth of excess capital that they have, right? So this is not even counting in whatever they will accumulate if earnings hold up. So even if they do give this away, they will still have enough capital, way above the MAS requirements. And their optimal CET1, the banks are now all same, is at 14%. Their current CET1 now is around 15+%, right? So we believe that even if they lower it, right, they will still be way above whatever regulatory requirements that MAS has, but also it's above, is at or above whatever that they are feeling is comfortable, and that they have enough capital to sort of tide them through the certain time, like the bad times. Yeah, so I do believe that they will return. But that being said, they might not continue it going forward, right? Depends on the whole environment, what happens in the next year or the next 2 years, whether or not they feel comfortable to return more. Because if you look at the figures that they have provided and the amounts that they're giving back, they will still have more than enough excess capital, even above their what they call the optimal level of 14%. And they also continue, as I said, accruing capital if they do have stable earnings, right? So whether or not they continue it in the next, after whatever they have promised, that is yet to be seen. But we still believe that they can do it for at least 1 or 2 more years past whatever they have promised. Yeah, so I hope that answers your question. I don't think there's any worry whether or not they will still continue paying whatever they said they will promise to pay. Yeah. Net interest income growth to be negative in view of tariffs, yeah, the net interest income, even without the tariffs, we believe that it's really sort of declining, but the banks have managed to lock it in, right, for at least one more year ahead. So they can predict this day, and we can also predict what their net interest income, net interest margins will be like for this year. And it will be negative, if interest rates drop, this will definitely go down because the loans will decline. So what was bumping up net interest income previously was, now at least, was that their excess deposits are quite large sum, and they can put that into longer tenure interest earning assets like bonds, and they earn that spread. But we see net interest margins decline because this spread is smaller than that compared to doing a loan, or compared to loan yields, right? So once this rolls over, and and they all their bonds that they locked in at a good good rate, they roll over to, let's say, a lower yield, then you will see the net interest income start to decline. But previously, we were thinking that, okay, if that does happen, at least the loans growth recovery will sort of offset some of that decline. But now with the tariffs coming in, what will happen is that loans growth may not recover as fast as we previously thought. So net interest income could decline slightly sharper than what we expected it to decline. Yeah, so I hope that answers your question. But it will still maintain relatively stable, at least for the banks. What's the current ranking for the banks? Yeah, it will be UOB, OCBC, then DBS. So UOB first, OCBC, then DBS. Yeah, maybe I didn't clarify earlier during my presentation in the slides part. Yeah, but for DBS, why we didn't put it there in our picks? It's not because they're not giving back a lot, or they're not doing well, but it's really because they were hit by this global minimum tax average. Why the other two banks weren't affected as much is because DBS does have a lot of their they shift a lot of their income away to less tax heavy sort of geography, so that's why they were able to get a lot of tax incentives, tax reduction. If you look at their average tax, it was only around 12.5%, right? Compared to the other two, it was like 14.5, 14% So that hit they get when the tax goes up to 15% for all the banks will be around 400 million for DBS. Hence, in 2025, we estimate that their net profit will actually decline slightly, but it's really mainly due to this higher tax rate that they have to pay. So hence, that's why it's our third choice. Yeah, I think I answered this one about do you see the banks still increasing the dividends? Whether I don't think they will increase it past what they've promised that they will. But like I said, they really have a lot of excess cash. So they will still, be giving back quite a lot. Like if you look at dividend payout ratio, it'll be around 60 to 70%. So I think that's what's positive for the Singapore banks. And now, more importantly, if you look at the current share price, right? The banks are trading at a dividend yield around 7.3%, right? And this is, of course, inclusive of the special dividends that they'll be paying out. Okay, I think that's all. Just let me just go through quickly. Okay, yeah. Yeah, someone asked, based on this morning sentiment, UOB dropped the most. Is this an indication of UOB will be worst impacted among the three banks? Yeah, no doubt UOB, because of their acquisitions, right? And then they did this, they finally completed integrated all the city acquisitions that they did. But I would say the bad part is that it's all in ASEAN, right? And that's where they are seeing their growth driver to be is in ASEAN. Because they feel that Singapore is a bit saturated, loans growth has been sort of slow, right? Not as fast as they want, right? So they put everything into ASEAN, and now they are like trying to sort of accelerate ASEAN growth, or at least move away from Singapore and diversify a bit. Maybe it's the timing, or they're just unlucky, but now ASEAN, because of the tariffs that come in, it might affect their plans a little bit, right? They were previously anticipating that ASEAN will be the main driver for loans, and that they're the only bank that really guided for high single-digit loans growth. The other two were mid-single-digit. So now I think they need to revise. We'll probably see some revision in that loan growth figure guidance. We will probably see it go down to mid-single-digit, right? Realistically speaking, mid-single-digit. But even with that we believe that they will still be the fastest growing as compared to the other two, because they do have that presence there, and it's not just let's say consumer loans. They're also going into they're really very heavy into the retail sector there as well, right? And they have finally integrated their UOB platform, where now you can access the same platform all across ASEAN, not just in Singapore. You have one, and in Thailand you have another. Yeah, so I think all these factors will be quite good for UOB. Hold on, sorry. I think there's one about Bank of China. Yeah, we don't really cover Bank of China, So we don't cover the Chinese one, so a bit hard for me to comment. Let me read up a bit and maybe I can see if I can have any opinion on the Bank of China comments. Yeah. Okay, I'll hand it over to the rest of my colleagues. I think there are quite a few questions. Thank you.
Thanks, Glenn. I'll take on some questions. Yeah, sorry, the questions keep jumping. There's a question. Will AEM, Franken, and UMS be hit with this tariff? Yeah, I think to explain the dynamics, can Fahmi, can you flip to the semicons tariff impact slide? Thanks. Yeah, but anyways, the customer of AEM, Franken, and UMS are generally equipment providers. So your ASML, Lam Research, as well as for AEM, I think one of their big customer is Intel also. Yeah, so so waiting for the slide. But anyways, for their book value wise, AEM's book value is 1.55. So currently they are trading at around 50% discount to their book value. Then for UMS, their book value is 0.58. Currently, they are still trading at a premium. For Franken, their book value is 1.02. So they are trading at a slight discount to their book value. Yeah, so as you can see from this slide itself, just now as I mentioned, AEM, Franken, and UMS, their customers are equipment providers. So how will they be hit with this tariff? Is that because equipment providers they export about 10+% of their revenue to the US. So for example, if US hits semiconductor with, for example, like a 30% tariff, then their revenue will straight away be I mean their cost itself will straight away increase by 30%. Then this will hurt their profit margins itself. Yeah, so if the equipment providers' profit margins are being hurt, maybe they will spend less on capex, and this will affect the Singapore companies like AEM, Franken, and UMS. Yeah, so that's how the dynamics may play out. Let me go to the next question. Which SG tech names are most impacted by the tariff? Yeah, so I'm not very sure of nanofilm, but I think based on the names that you listed, in my opinion, I think AEM will be impacted the most because for Intel itself, they have the highest revenue percentage to the US, and they also outsource about 30% of their manufacturing to TSMC. So if US hits Intel with a tariff, their costs and exports to the US will straight away increase. Yeah, so that's my opinion. Next question is, will the construction sector still boom during a recession? In my opinion, yes, because currently, just now based on the chart, that contracts awarded have spiked, right? In my opinion, a lot of these contracts awarded are public contracts. So because the Terminal 5 is coming up and it is such a huge project that it actually will drive the growth in construction itself. So and Terminal 5 actually starts construction in the first half of this year. So even if the trade war may come in and recession may come in, my opinion is that the construction will still continue lah. Yeah, I mean the construction of Terminal 5 will still continue despite all this. Yeah, so I think that the construction sector will still boom. Next question. For Pan United and PRC Asia, which one is a better buy for dividend for long term? If you look based on dividend yield itself, PRC Asia would be a better dividend buy because PRC Asia's dividend yield is around 7%, whereas for Pan United, their dividend yield is around 4%. However, fundamentally, we like Pan United more because PRC Asia's their revenue have been impacted by the drop in steel prices. However, for Pan United, they experience revenue growth and profit growth for the most I mean, for the past few quarters, because ready-mix concrete prices are holding steady. However, they are increasing the volume of ready-mix concrete. So, in my opinion, if you ask me purely based on dividend yield, BRC Asia will be better. However, fundamentally, we still like Pan United better. Yeah. This is reflected in our calls as well. For Pan United, we have a buy call. For BRC Asia, we have an accumulate. Yeah. Next question, TSMC. Sorry. Intel and TSMC are having joint venture to develop chips. Any positive impact read by AEM on this move? Yeah, I think potentially AEM may benefit if this actually materialize, because I think based on the rumor itself, TSMC may take 20% of Intel's manufacturing foundry. So as we all know, Intel's foundry hasn't been doing very well because they are losing market share to, for example, AMD in terms of their CPU chips. So Intel being a very big customer to AEM, if their manufacturing can recover because of this acquisition by TSMC, then AEM will definitely benefit. There's a question. If the tariff excludes semiconductor sector, why Franken, UMS, and AEM dropped so much today? Yeah, correct. You are right to say that tariff excludes semiconductor sectors. Currently it excludes, but however, Trump has been hinting that he will hit semiconductor. So I think it's just the expectation people have that he will hit it in the future. And as can be seen by the chart just now, the semiconductor impact, if there is a tariff, right? The companies will actually be hit quite a lot if there's a tariff. So I think people are just preparing for the worst. Yeah. Yeah, I think there's a admin question. There are numerous webinars on strategies and stock picks for various markets in coming days. Where can one view the recorded slides? We post our slides on YouTube. You just have to search PhillipCapital's YouTube channel, and you can see the webinars from there. Yeah. There's a question: how will tariff affect companies like UMS? Yeah. I think I've answered this previously. So, like, tariff will just, I mean, in a nutshell, it will just increase the cost of semiconductor companies. And for UMS, their main customer is equipment providers, for example, ASML, Lam Research. So if the cost of these companies go up, they will naturally want to spend less because they will become more conservative, and this will affect companies like UMS. Next question. Are you sure semicon is exempted from reciprocal tariff of Taiwan of 30+%? There might be additional sector-specific tariff on semicon and pharma are coming. Yep. Currently, all semiconductor products are exempted from the tariff. So for example, Trump slapped Taiwan with a 30+% tariff, right? However, this exempts semiconductor. Yeah, so TSMC is not being directly affected currently. Yeah, so there may be upcoming tariff as you said. So we still have to keep a lookout for those. Yeah. Next question. Semi are exempted from the tariff, so how will they be impacted? If you're asking in current terms, they won't be directly impacted lah. But I think now people are just preparing for the worst if Trump actually hits the semiconductor with the tariff. Yeah. Yep. I think that's all for me for now. I'll hand over the time to my other colleagues. Thanks.
Yeah, thanks, Ivan. Yeah, with worldwide tariffs, do we need to avoid S-REITs with overseas exposure? S-REITs seem to be smacked every time they try to rebound. Yeah, so we don't think so. We don't think you need to avoid S-REITs with overseas exposure because basically tenants, they still have to pay rent, and most of the REITs, they with overseas exposure, the REITs have already properly hedged their either a percentage of their income that they generate or just hedge the loans also through natural hedging. So yeah, generally we don't think we need to or investors need to avoid S-REITs with overseas exposure. Yeah. Okay, let's see. Stoneweg European REIT planning to convert into stapled trust. Can you briefly explain the approach in doing this and what is the implication on investors? Yeah, so basically, from the income perspective and dividends and share price, not much impact. But what Stoneweg they're trying to change into a business trust structure because it's more like a preemptive measure. For example, under a REIT structure, if Stoneweg let's say they install solar panels, they are not allowed to trade back the electricity that's generated from these solar panels that they installed on their buildings back into the grid under REIT rules, but under business trust rules they can do so. And they're also looking at some possible land developments, data center land developments from their sponsor PhillipCapital. So usually REIT rules also they have a 10% limit, and by changing to a trust, there are some potential tax savings as well. Yeah, from all these arrangements. So yeah, it's a positive sign, and it's more of a preemptive measure for future growth. Yeah. Uh, Sorry, let me skim through the questions. But in a recession, the tenants may not have a business and hence may default in their rental payments or may move out. Will this not drop the DPU to? Yeah, so this actually will drop DPU, but usually there is if that unfortunate situation happens like in COVID, usually there is a time lag. Yeah, but it's more like a second order um a second order effect from a recession rather than an immediate effect like other companies. When you have recession, maybe there's the retail, for instance, your spending straight away will decrease and immediately impact the top line. But for REITs, basically even if any recession happens, they still will have to pay rents, so that is fundamental. But unless if the tenants default, then the rental payments might not come in and they might default, and eventually will impact the DPU. But that is more like a second order rather than a first order impact. Yeah. So fundamentally, the REITs they still have to pay rent. So yeah, it's generally more resilient than other companies. Yeah, all REITs dropped today. Rate C, yeah, not only REITs, everything dropped. So can't really just say that REITs dropped today. Yeah. Stoneweg is going to change the trust what's view. Yeah, it's more of a positive. Yeah, like I mentioned, it's more positive from our perspective where they are preparing for future growth, the potential data center development, and maybe even selling back some power back to the grid that's generated from their solar panels that they install on the buildings. Can you share your insight on DigiCore REIT? Yeah, so Digital Core REIT is a pure play data center REIT. So it's similar to Capital DC, the only two pure play DC REITs. From a yield perspective, Digital Core REIT is definitely more attractive than Capital DC. It's trading about 7%, while Capital DC is about after the share price correction is slightly under 5%. Yeah, but for Digital Core REIT, their DPU is expected to fall because one of their big tenants, Linden Hall, is expected to be vacated soon. Yeah, so DPU is expected to decline, but generally the rents we saw, they managed to backfill their LA data center was at a good rental reversion. Yeah, but generally still expecting some DPU decline for Digital Core REIT this year. So I'm confused. Initially, bulk of the analysts were saying interest rate will not be cut much or may even go up due to Trump's inflationary policies. But now you guys were saying more interest rate cuts going forward. What's the logic behind this sudden change and inconsistency? Yeah, especially when you mentioned more interest rate cuts going forward is good for the REIT. Yeah, so generally, back then, because of Trump's supposed tariffs back then, before he actually implemented the tariffs, there were some worry about the inflation being sticky and being high. So as a result, for the Fed to control this inflation, they have to keep the rates high. But back then, the recession risk was still not so high, and unemployment was still at, if I'm not wrong, I think 4% or something, or 4.1, 4.2%. So it's still low. So as a result, the market as well as the Fed, they believe that the rates could basically they were more hawkish for higher for longer rate interest rate environment. But now that the markets are like that and the tariffs are in play, so the Fed is now prioritizing growth as i.e. employment over inflation. So it's a risky balance between both. So it's kind of inflation and unemployment is kind of offsets, or rather they are like against each other per se. So if they want to keep unemployment low, they likely have to lower the interest rates, but that will impact inflation. So now since the Fed, they are prioritizing employment over inflation, it's likely that they'll still have to cut rates to drive growth in the economy and in a bid to try to keep the unemployment rate low. Yeah, I hope that answers the question. But basically, yeah, actually, I just saw the latest futures market. They're not only pricing in 4 rate cuts, they're actually pricing in 5 rate cuts already. Yeah, so with more interest rate cuts, basically that will benefit the REITs, as a lot of REITs, they are 40% geared. So with that 40% loans on lower interest, definitely the potential for higher distributions will be higher. Yeah, hope that answers that. Please comment on outlook for Parkway Life, FCT, CICT. Yeah, so Parkway Life REIT, outlook stable. They will have a rent kicker from the Singapore hospitals and starting next year, 2026, when I forgot what it's called, the project, the Mount E Hospital is complete. Project Renaissance, yeah, if I remember correctly. Yeah, so that will drive, or rather will increase their dividends quite significantly, but they're still paying a low yield, if I'm not wrong, of 4%. Yeah, because the market, I guess because of their Singapore hospitals, that's why they're trading at a low yield and a high price to NAV. Yeah, so yeah, from a yield perspective, Parkway Life REIT doesn't stand out as attractive to us. FCT, their portfolio basically is still very resilient, mostly in suburban malls. So in a slowdown, in an economic slowdown or recession, FCT, like suburban malls, they're focusing on essential trade and essential spending like your F&B and such. So FCT tends to be more resilient with a full suburban portfolio. And CICT, that's also relatively resilient with some suburban and downtown malls for CICT might be affected in a economic slowdown. And for office, for CICT also, it's likely that rental reversions might remain flat. It's unlikely that they can have some strong positive rent reversions, as a lot of their rents are already priced at, or rather very close to market rates. So it's unlikely that they can keep raising rents for their office as well. So yeah, those are some quick comments on these three. Just a little note on the North Point, the recent acquisition of FCT, North Point City South Wing. Yeah, so we are more neutral on that deal. It's good from a perspective that they are expanding their portfolio and they'll have some potential operational synergies with their North Wing that they already own. So if they combine it, like maybe they do some electrical piping and some such or yeah, just combine the operations. There might be some cost savings there, so that will likely benefit FCT. But from the deal itself, we are more neutral because the MPI yield that the deal was at 4.5%. So it's at a lower yield compared to Next, which was last year, acquired last year. So that was at 4.8%. And it's structured such that a lot of the accretion was structured such that a lot of the loans that they take at a lower interest rate is used to pay the higher interest debt. So that's how they managed to get that slight accretion. Yeah, otherwise it's more of a neutral deal for us. Yeah. Yeah, could you explain the price drop of REITs when market expects 5 interest rate cuts? Yeah, so it's just across the board. Everyone's just selling. So yeah, can't really explain the price drop today, but yeah, basically just a huge sell-off across the whole equities market in whatever country, in every country. Yeah. Yeah, thanks, CK. Yeah, Parkway Life Project Renaissance to be completed mid-2025. Yeah, thanks for that. I've just recalled when many REITs will retain their DI and not pay out proper amounts of dividends. A good example of such is SPH REIT, which retained the biggest percentage of the REIT. Paragon REIT was the first REIT. Yeah, if REITs they retain their DPU, that will definitely affect the, or rather if they retain their distributable income, that means they hold back for any like a backup for unforeseen circumstances, like how some of the US REITs also, they are not paying dividends, or they lower their distributable income to 90%, because that's a threshold to get continued tax transparency. So yeah, so if they decide to hold back, instead of paying 100% payout, they lower it to 90%. That will definitely affect the DPU also. Yeah, I think that's all questions from your hand over to my colleagues. Thanks.
Yeah, okay. Thanks, Darren. Let me just try to answer some. Hi, Paul. Do you foresee any margin call for SGX shares, in particular those held by foreign institutional funds? Probably not in Singapore. I think most of the funds, we don't really get much hedge funds. My presumption is we don't get much hedge funds in Singapore. We're not that volatile enough. And usually, excluding hedge funds, the long only funds usually don't take any leverage. You're talking about unit trust, insurance, they hardly leverage. What's your take on further downside pressure to Singapore market, especially in the context? Yeah, okay. So this is, like I said, 99% guesswork, right? So my only guess is what will be the pressure point for him to change his mind? April 9 will be the day. One scenario is maybe he might push out this tariffs, maybe give a 90-day grace period. That could be one scenario, and probably one last big sell-off could be on April 9. I mean, if it doesn't change and no change, because it's supposed to be implemented 9 of April, and if that gets away, then maybe we could get one more round of selling. So if I had to take a bet, I mean, purely hardcore, like Genting, Marina Bay Sands bet, will probably be the second half late of tomorrow, maybe the second half of the market time. Because that will give you the window. Maybe he might change his mind. One possibility, he won't reduce the tariffs, but he just give a grace period. Then from there, maybe give him time to because the question now is what are the pain points for him? So we don't see, the only pain points is, like we mentioned, the midterm election is not going to happen. He's already last term of election is not going to impact him. So there's really not much unless he really sees the economy really slowing down really sharply. Yeah. So there is really no major pain point for him right now because he's not seeking for re-election. Are we seeing a repeat of Black Monday emerging market sell-off at S&P? Yeah, we definitely see. I mean, the banks dropped 15%. Part of it was also ex-dividend. But for emerging market, you really need to look at the currencies. So far, although Indonesia currency has weakened, but I don't see it crashing because I think the US dollar is also facing some pressure. Yeah. Paul, curious your guess how the trade war will play out. I think at this my guess is that this level is not sustainable. I mean, this level of tariffs, you really going to shock the whole economy. It's like almost 70-80% of a recession. So my guess that he will probably have to find room to dial back. I mean, we've seen this playbook with Canada, just 1 day or couple of hours before the implementation, he might actually dial back, and he's facing pressure. I mean, everybody, even Elon Musk, also his #1 cheerleader, is also condemning this. I don't see anyone actually recommending, unless you're a bond investor, you're celebrating. So he seems to be facing a lot of pressure points. Yeah, but I think that's the good and bad about this whole thing. It can be reversed by just one single decision. Yeah. But the longer he waits, I mean, obviously the damage will be worse. Paul, you mentioned Fed chair favor growth over inflation. So with Dodge laying off so many positions recently, it's not that it will spur earlier rate cut. Yeah, but we haven't seen that. Actually, the jobs number in the US is still strong. Yeah, I think you notice the latest number was about 200,000 against the estimate. Although the government jobs has still been coming down, but I think the like healthcare and all that has still been holding up. So that so Dodge really no impact. You don't see any impact. I think the numbers will only get worse if you look at the May onwards data. My only guess, because the impact is now April will still have good numbers because everyone tried to ramp production, try to get ahead of it. Then maybe you will see the weak numbers starting to happen in May, because this thing is just happened. So May, June you start to see the weak economic numbers. Will Keppel and Citron be impacted? No, nobody is directly impacted, Keppel, Citron, because they don't sell to the US directly. It's more the indirect, because with the oil price dropping, then of course it will be harder for Citron, harder for Keppel to sell their vessels. You know that I think 4 billion US of vessels they wanted to sell. But the one thing is that this weakness may actually raise the chance of a merger between M1 and StarHub. I mean, that's our only guess, or at least forced marriage. I know, yeah, because they got they got the same parents, right? So forced marriage. I shouldn't say that. Actually, it's not the right thing to say. They have the same parentage. Yeah, they can actually cause a forced marriage between these two companies. Yeah. For Citrum, again, it's just a trading thing. Just trade it like an all stock. Yeah. Because the problem now is that with the oil price so low, I mean, this stock is probably now trading at 30 times PE, and hardly the profitability is hardly any profit with this kind of yeah. So we never liked Citrum fundamentally, but again, it's just a trading stock, move in line with the oil price. Hi Paul, how long do you think this market rout will continue? Some experts liken it to the 1930s Great Depression. Do you see this? Yeah, the only thing that holds me back is the amount of the two things. I mean, the amount of leverage isn't high. So the worst thing you get is that if there is also a bond, if bond yields start to climb back up, then you're really then you really know where to go. That means you can't get a fiscal spending in Europe. So if bond yields in Europe start to climb back up, then if you recall 2013, that's the reason why Europe couldn't increase fiscal spending. The government couldn't spend because the more they spend, the more higher bond yields climb in Europe. But that is not happening. So if I last checked it, so that gives room for governments to kind of spend their way out. And you don't see much leverage in the US system. Most of the jump in the US equities is because all the capital from the whole world just went to the US. I think our last computation that we did, almost 3 trillion of equity of flows went into the US market from foreigners last year. So I think that's going to pull back, that's going to dial back out. And of course, Japan, everyone is also starting to do fiscal spending. Yeah. Did I accidentally answer one that I didn't? What's your guesstimate of odds of a US recession? If nothing changes, very high odds of a US recession. Yeah, because like I said, it's a consumption tax. It's like Trump just tax everybody. So the government finances will look better now, but it was going to cause the everyone to pull back on the consumption spending. So the problem you have is when, like I mentioned, when you have this negative spiral, right, and you cause this vicious downward spiral, there's nothing to short circuit it to come back up. Yeah, so this thing will just keep on, like I said, the lower sales, lower hiring, lower sales, lower hiring. So that is the worry. But yeah. anti-Trump protests have sprung across US over the weekend. Will Trump feel any pressure to dial down? I don't think he will. But if I had to bet, maybe just before the April 9, he might prolong it. I mean, this is a bet. I mean, how to who actually understands what he's thinking about? That could be one way to placate, because everyone is really the pressure. Every company, every CEO is condemning this thing. I mean, so yeah. So that is our own guess. So the one way to bet is the one last round of heavy selling will be April 9 in the US, because that time everybody will know no, he's not dialing this back. Then maybe that could be the last short term leg before we get some short term bounce. A lot of info shit from before the global market drop. Any revision or assumption? Yeah, we might dial back some of our estimates, maybe the banks or 1-2%, but some of the sectors like gold, you're not going to dial back, right? Because the gold price is still high for now. Then our assumption is 2009. Coal price is maybe dial back a little bit, but our assumption is production growth. Our construction won't change. So REIT also, we're not going to dial back, maybe even raise the target price a bit because interest rates are coming up. It is only manufacturing where you really might have to really take a bigger knife to go and cut back. But having said that, I know there are lots of semiconductor questions. So for me, at least from my own point of view, the one that I like would be Franken. So why I say Franken is because it's already trading below book, about 80 over cents. And secondly, their big customers is ASML. So you put tariff also, ASML still going to sell. Because ASML is a monopoly, right? With a 50% gross margin. So it's a chance to get exposure to this monopoly, I guess. And also remember, most of the semiconductors customers are mainly in Asia. So UMS customer, they're all their customers actually in Singapore. So UMS will maybe assemble in Singapore, then send to Applied Materials in Singapore. Then Singapore will ship it to Taiwan. Then Taiwan will maybe ship it into the US for NVIDIA to go and assemble the thing. So there is a path to avoid the tariffs for semiconductor. The reason why we're negative on semiconductor is mainly because we think orders will dial back. But again, semiconductor equipment especially got big margins, and most of them are monopoly or quasi-monopoly, like Applied Materials and all that for their respective etching or lithography. Is Q&M considered defensive stock? Yes, in the sense that dental procedures will still go ahead, and especially right now the government is stimulating. They're giving bigger subsidies for those who go for dental treatments. I forgot the amount. Sorry, it slipped my mind. But if you go for more advanced treatments, I think they recently jacked up the subsidy. Sorry, just slipped my mind the amount. But it is considered a defensive stock for healthcare, and I think the company is doing share buyback. Any tariff impact on Yangzhejiang? Nothing. But I think they get hits both ways because Trump still wants to has talked many times that there is a lack of shipyard capacity in the US. So he has not implemented the fee, but he's targeting that. And of course, container rates, we can assume already collapsed 50% in March, and by the 2nd April, probably collapse another 10-20. Probably you're talking about 60-70% collapse in container rates, and container ships are their largest customer. So that is also another major impact. How will Propnex be as home sales may reduce? I think it will slow, but it will still. We are looking at a 30% growth in home sales. Of course, now is so even if it dial back, it's still going to be above our forecast. Yeah, but definitely, of course, sentiment will also be impacted. I mean, you're going to buy a 2,200 per square foot when everyone's so worried about recession. Yeah, but the good thing is that the interest rates will collapse even more, so that is the offset for them. Yeah. Will venture be hit hard? I think venture will be hit hard, my own view, because they're like I said, contract manufacturers will be the hit the most, because semiconductor, there's still a path to exit because your customer many TSMC, so then TSMC export to US, so there's still a path to avoid tariffs. But for venture, not really. I mean, they are mainly we don't know how much they export to the US because they don't disclose, but I think venture will also be hit hard. Contract manufacturers, you sell to the US, you got a plant in Malaysia, you get a 20%, then you probably have to your customer will cut back your orders, and your customer will also ask you to share part of the burden. Yeah, so they will be also hit. what do you think the Fed might respond to tariff and their potential effect on economic growth? 4 cuts have you mentioned? Yeah, I still think there'll be cuts, but it will be a lag cut. I mean, they will probably wait and see because they can't justify because when the numbers come out, you probably see inflation rise, but employment, he won't do a cut until he see employment start to come down. But he might signal that. So he might signal that they are ready to cut. So I think when you go into probably the June FOMC meeting, or July, I think there's one there, sorry, but I think you will only see him talking about it. So what might happen is he won't just suddenly cut, he'll probably give hints. So the thing to watch is to look for hints that he will that they might that they will do some, and of course Donald Trump also pressuring him. I mean, but for what it's worth. Will CSE be impacted? CSE, no. I think CSE might is probably immune to it because most of their business is inside the US. So they are totally not directly totally not impacted at all. Yeah. BYD, I'll leave it. How will companies like Ortec be impacted moving forward in view of tariffs? And probably nothing. I think unless all palm or all prices or palm oil price start to drop, but not really. The Pertamina contract is still ongoing. It's just that the Pertamina contract, because it's Hari Raya, right? So you probably have to assume the whole 1 month that everything is all slowed down. So I don't think they will be impacted in that sense. Yeah. Okay. I'll leave up to the what's the impact of tariff like? Okay, for First Resources, not much. You just have to watch the palm oil price. But for Wilmar, a bit trickier because they got the US exposure and they also import soybeans from the US. So why we always hesitate on Wilmar is because Wilmar is always do a lot of trading. So they might have already kind of take advantage of that and kind of long the soybeans coming up from South America. So they might have preempted that. So but if I had to buy, I rather prefer First Resources. It's a bit clearer. For Wilmar, you got the China exposure, so it's a bit less clear for us on Wilmar. I will try to attend the AGM, then I'll try and see what they say and try and give back, try and provide more information. Can you elaborate more on the 9? So 9 April is when the reciprocal tariffs are going to be implemented on 9 of April. So our hope is that if our bet is that maybe before he implement like what he did to US and Canada, he might give a bit of grace period. Again, I do not know. I mean, this is Donald Trump, right? Who actually knows what he actually thinks right now? But there is one possible scenario. Then, if not, then probably April 9 could be one more round of selling, because but that could then the selling could actually slow down a bit because by then everybody knows really it is going into effect. So you're just taking that bet that it's almost like a binary bet that he might delay the thing, or if he doesn't do it, then there'll be just one more round of selling. I mean, that's or you can just wait until April 9, but then you might miss the opportunity of a short rebound if he delays it. So that's our logic. Okay, again, this is like I said, is totally guesswork. I mean, we really do not know. Probably nobody knows what he will do. But if there is one scenario you want to trade around, that could be it. Yeah, maybe one more selling tomorrow in the morning, then maybe that would be the chance. Any chance for Yang Zhejiang price to recover? I do not know a scenario that it can recover because it's getting hit double, because it's hit by the low container rates. Their container customers might pull back, and also Trump just wants a shipyard capacity. I think he mentioned it many times. Or if you listen now, but they haven't implemented that fee on Chinese ships yet. So it's going to be a big overhang on Yang Zhejiang. I mean, you want to buy this stock, then one day Trump just say, "Oh, I'm going to put fees on Chinese-made ships." Then it's just going to get whacked one more time. So that's my concern. So like you talk about Singapore banks, all these are indirect impact. You talk about construction, all indirect, but Yang Zhejiang a bit different. There's a direct impact. There's a line of sight where they can going to get hit. So that one, yeah. How will Valuetronics be impacted by all these issues? Yeah, Valuetronics will be hit quite hard, I think. there's really no way to avoid this. They might have to go and look for another plant somewhere, I don't know, Mexico or even Malaysia to avoid this. Because there are only two plants is China and Vietnam. So and they are not a semiconductor manufacturer where at least like you mentioned there is a path to avoid tariffs. So those will be hit hard. Even venture, they're not semiconductors. So contract manufacturers will be hit really badly. What's the tariff impact? Yang Zhejiang nothing. Yang Zhejiang has probably some shipping funds. So the impact on them won't be they've got some shipping funds, so maybe that will be impacted, but not so. I think like half the balance sheet is all cash, so probably they benefit now. I mean, if they're holding so much cash. How is Genting affected? For me, it's not just sentiment driven. Even before these tariffs, I think Genting probably gonna have another week, first quarter, another week, second quarter, first half, because like we highlighted before, the high roller segment really took a dip only in the third quarter of last year. So you're going to have another first half of week results coming in. Yeah. And of course, you also have this worry of Thailand coming up with a casino. Companies like SBS, Transit, and Comfort will actually benefit because of lower energy prices. In a way, there will be a I don't know how to quantify it, sorry, but there will be some benefit. It's supposed to be passed through, but totally almost most times not everything is passed through. So there will be some impact. Yeah, but most investors will just buy whatever has been sold down the most, rather than go down to these names. I mean, yeah, all tech dropped 15%. Yeah, I think nothing has changed fundamentally. All this is the selling right now is all liquidity driven. As you know, capital is a coward, right? I mean, which I don't blame people. I know, yeah. When any sign of distress, the capital will just run. Capital is like a coward, so which is understandable in these circumstances. But fundamentally, no change. So for Alltech, we are hoping them to announce a few more contracts. Then you're going to get the bonus issue. Then after that, you get the Pertamina finalization of the awards. So that's the path for the recovery in the share price. Yeah. Okay, I think I will hand it over to the rest. There's still quite a bit of questions. Yeah.
Sorry, just a short clarification. Currently, the tariff excludes semiconductor products, but however, it includes semiconductor equipment. So for example, Singapore companies like UMS, Franken, and AEM, they will be affected by the tariff. However, as what Paul said, Franken has a very low exposure to the US, so we still like Franken out of the three. Yeah, thanks.
Yeah, most of the wafer fabs are in Asia, not in the US. There is, I mean, TSMC is going to build one, but maybe Intel has one tiny one, but most of the supply chain is in the US. So the equipment guys won't be impacted. I think if you look at the numbers, UMS sales to the US is about 13%.
Yeah, thanks, Paul and Imran. Yeah, there's one on BYD. How is BYD affected going forward, including the dynamics of EV worldwide? Yeah, so it's very interesting. BYD currently does not sell, say, directly into the US. Most of the Chinese companies, they try to avoid it, right? They're going outside of the US because of all the existing tariffs that already were in place, right? And they sort of left that market to Tesla and say, okay, you can have that. But if you look at BYD's, I would say, main competitor overseas and everywhere in the world would be Tesla, right? So we do have coverage on Tesla. I'll speak more on Tesla now. Maybe I'll go to BYD. Firstly, Tesla, they do have quite a bit of the parts, right? They do say that they are American made, right? But I think around 25% of the parts, they come from outside, 10 to 25%. So a total about 35% comes from outside of the US. So 10%, they don't say where it comes from, it says others, but we assume that it will be coming from China, mainly maybe it's their battery components or materials. So, just based on some back of the envelope calculations, we could possibly see that their car prices, even in in US, will increase by around 10%. And that's on top of whatever they are facing currently, right? There was so much backlash with Tesla due to Elon Musk, their CEO, sort of affiliation with the Doge, and with Trump. So, a lot of people were not. Firstly, they were not buying new Teslas, and you could see some of them even, trying to make their Tesla look like a Toyota, right? So that's quite funny. Where previously, a few years ago, you would never expect this. You would think that Tesla, you'd be so proud to own a Tesla. So that has made the volume and the demand decline. And overseas, in the other markets, it's not just the perception of Elon Musk, but it's also the cost of the car is a lot higher, and the quality and materials are not as up to par with the Chinese EVs. So in China itself, the yes also dipped. Here in Singapore as well, you can see BYDs are selling like hotcakes, whereas nobody really looks at Tesla as much. So I think a lot of differences. Tesla is sort of declining. Then you go to BYD, they have surpassed Tesla in terms of sales, right? Sale amount, at least you talk about the monetary amount, right? They have surpassed Tesla. And they are very heavy in the Chinese market as well as in a lot of their, I would say, external markets. So they, maybe in a sense, they did the current tariffs that Trump implemented on Chinese EVs were really so high, and also now there's additional tariffs, then it might even, they're probably saying like, okay, I won't go into US, but I'll concentrate on all the other countries. And if you look on the flip side, Tesla's, if they move to other countries, it will also cost higher for them because, of all the tariffs that are coming in. So that's not very good for Tesla when you look into the near short term or even the medium term. Whenever you listen to any of his calls, he's just talking about the other parts of his business, which is like the robot and AI and self-driving. So that haven't come into fruition yet. So back to the question, BYD, it's not as affected. It might have affected, some of plans that they might have. They might think that they want to enter the US market because it's a very large market. But now, with the additional tariffs, that if they do come in, that might actually stop them from entering the US market, or it might not make a sense, their profit margins may not be high enough to enter a brand new market and like really push sales there. So I think BYD, in terms of affected, it really affects how fast they can grow, but they'll just maybe go all in the other countries that they're in currently. Yeah, so I hope that answers the question. It's a very long about question to just answer one question. Yeah. Sorry, hope it's clear enough. Yeah, there's one on iFast. 2 questions on iFast. What's the view on the impact of iFast? What's the base impact on iFast? Again, iFast isn't directly impacted by the tariffs, right? It might be a bit of sentiment driven. Most of the whole market was sold down, so iFast couldn't escape it. If you look at iFast business model, it's wealth management, and now they are trying to diversify into the bank in the UK, right? So previously it was they finally made a profit in terms of the bank, their banking arm. But now the worry is that, if there is a dip in like economic activity, right? There's a whole dip in economic activity. This might actually hamper their goal to continue growing deposit base. So their main goal now is to continue to grow their deposit base, and try to expand further, and maybe even possibly take a bit of the market share away from the dominant guys in the UK, dominant digital banks in the UK, right? So that might hamper their growth, which is why we possibly see a bit of a sell down in iFast share price. In terms of their wealth management arm, the volatility will sort of improve, might improve a bit of their fee income. But then again, if there's a whole, overall downturn, then this, it'll more than offset whatever they get from the increased volatility. Yeah, so it's really a bit difficult to say for iFast, right? Where their bank will be headed now when it's so uncertain, especially in the UK market that they are in. But direct impact wise, there isn't any direct impact. It's very similar to the banks, like Paul mentioned. There is no direct impact, but a lot of the indirect impact will actually flow directly to these companies. I think that's oh yeah, there's one more about SGX. Yeah, similar to iFast, it's really very similar. There's no direct impact. If anything, we might see volumes go up, right? Because the VIX is so high, right? Volatility is so high. But then again, if it's a long-term downturn, I would say they will also be affected, right? Like all the other companies out there that they have no direct impact to the tariffs. Yeah, so I think that's the only thing that can be deduced from that. Yeah. Yeah. I think that's all. Maybe I'll hand it over. Maybe Zane can do the TA. Oh, we already passed the 1 o'clock. Yeah, but yeah, hand it
Thanks,
over to
Glenn. Yeah, I'll touch on the TA question. So I'll just share my screen right now. Yeah, so first question is on DBS, the local banks. So for today, I think DBS has some resistance, probably around close to the day highs for around $40.40. Because today there was a breakdown below the 200-day MA, but also coupled with the ex-dividend. So, but $40.40 to about $41.20, there's some resistance over there in the short term. I think for now we could still see some weakness towards maybe like 34 to 35, then that could be a bit of a stronger support, where previously this was a prior resistance area. Then on the weekly itself, this also coincides with the 100 SMA level. Yeah, so that might be a better support. Yeah, then going to UOB. So UOB similar, there's some resistance around the 200-day MA around 34.40 level. So a good support might be closer to about 28 or 29 area, where actually there was a prior resistance and coincides with a longer term support line as well. Yeah, so if the price actually comes down to this level. As for OCBC, yeah, also finding all three banks finding resistance at 200 MA today, close to $16. So there's a short-term resistance. For support, might be looking at a bit lower towards in the near term would be around 1480. Yeah, and then if we look at the weekly, in terms of the weekly MA, the next one below that would be around 1380, the 100-day 100 MA on the weekly. Yeah, so that's for the local banks. Okay, then I'll talk about next one is SIA. So for SIA, yeah, today broke down two levels, which was at 645 as well as 626. I think short term, likely to see the price come down further to retest at least maybe 595-day swing low, and then overall is in this big range. So previously around 578, this was quite a strong support in this range. So this might be the two next support levels to look for where the price can hold at these points. Okay, then for SGX today, there's a breakdown below this uptrend channel over here. So there could be a bit more of a downside hit. Next support level will be around 1150, this level, and then as well close to about 1070 next. And for sets, sets today still very strong, same momentum on high volume. As you continue to trade within this downtrend channel, there could be quite a strong sell-off as over here, which could bring the price a bit lower. So next level is around 260 over here. I think the price might be maybe hit like 240 for a strong support. So 240 was previously back in 2022 to like 2024. This as a strong support over here. Price might then have a better bounce if it does reach to these levels. Yeah, so for Wilma, I think today also hit a support level around close to $3, but there could still be some further weakness ahead from the recent breakdown. So next support level could hit maybe like close to 290. Or if it touches a longer term trend line, that could be maybe like close to 285 to 290 area. Then next one for STA drink, relatively stronger than the rest. Today, it's also down about 7%. So I think with that, we could still see a bit slight further pullback. Maybe it could test like around close to 580 this level, which was a swing low support. Also might do a mean reversion towards the 50-day SMA over here. Okay, then next up for Singtel, Singtel today retested an upward support line over here, as well as around the horizontal support around 330. So, but with the fresh breakdown below 340, there could still be some further pullback ahead, maybe towards 320, which was another previous range breakout level, as well as a retest of the 100 SMA level on the daily time frame. Okay, I think I'll go through perhaps maybe like around 5 more counters as we just crossed above or over 1. So sorry, I'm able to go through all of them. So yeah, so this one important will be the one looking at STI. So in terms of STI chart, yeah, today's sell off 7.5% as of now. We could still see a little further downside if it does retest this trend channel support level. So the strong support level might be around close to 3004 over here, which coincides with a previous range breakout level as well. So if you measure from the current levels, that might be another like 4% sell downside from the current levels before we might hit a strong support. So that's for STI. Okay, then for Keppel, yeah, Keppel also a strong sell off today. Price, we might see price hit towards 575. This range consolidation level over here, and see whether there could be some rebound, slight rebound. And then for Senco Industries, first, it could likely test the first support level around 567, which was this previous consolidation level. Yeah, then we might see some slight rebound from this level. It's also at 100 SMA level on the daily time frame as well. Yeah, I'll touch on 2 more counters, which are CapitaLand Ascendas REIT and CICT. So for CapitaLand Ascendas, today see a breakdown below this 258 level, so we might see some slight further downside on the current momentum to maybe retest 247. This range support level consolidation since November of last year, then we might see some slight bounce. And then for CICT, yeah, today at this retesting this 206 swing low level, but I think we could still see maybe some slight downside, maybe towards 195 to about $2 this area, which previously was a breakout level here. Yeah, so that's for CIC. Also coincide with some on the day on the 50, 100 and 200 SMAs on the daily as well for CICT. So that's for the TA. Thanks for all the question, but sorry, unable to take all of them as we've exceeded the 1 o'clock. But feel free to post your questions in the P3 TA community group. Then I'll take it over there. Yeah, so I'll stop sharing my screen now. Thanks for all the questions.
Okay, yeah, thanks everyone for your time, and hope it was useful, and wish everyone a good week ahead. Yeah, thank you everybody, and take care and have a good day ahead. Thank you everybody. Bye.